Hello, and welcome to a market update from Sharewise. My name's Lachlan Callaghan. I'm the trading floor manager, and today we're going to be talking about a few things. We're going to be talking about what's been happening, why it's been happening, and realistically, what's going forward. And that's the big thing. The topics we're going to deep dive a little bit into today is dividends, and realistically, are your dividends safe? So, if we jump into it, the Aussie market realistically, we're at 2019 levels. Where we're sitting right now today, we're at 2019 levels. It's not the end of the world. But for a lot of people, it does feel a lot of pain. But why do we feel this pain? Well, because Australia's slowing down. We've got persistent inflation. We've got increasing interest rates, decreasing disposable income, slowing economic growth, and the government aren't spending as much. We're not being stimulated. And so that's putting a real big dent into everyone's day-to-day. We see it, you see it, everyone's slowing down, which is good. It's needed. It means that the policies are working. Australia's been facing these problems for a while. Inflation's been a major, major issue. We've steadily been rising in recent months, which is a little bit concerning. But realistically, it's been reaching a 30-year high, 6.1%. We needed to bring that back. So the major things that have been driving this inflation still is supply constraints and rising energy prices. I'm sure everyone's been seeing the power bill go up. It's the sort of thing where, okay, unfortunately, our retail market is still very strong and our unemployment is still very strong. It's giving evidence for the RBA to keep rates at where they are. And that's exactly what they did. October, September, they didn't raise necessarily, but they did pause. But they're still very, very much biased to raising one more time. Now, it's the sort of thing where, okay, going forward, they have to cut. They can cut. Why haven't they cut yet? And it's because we are very, very much are a strong market. And we need to see a shift in dynamic change in unemployment and in spending habits and behavior. And we'll go into a little bit more into that further on. The other big thing I want to talk about is realistically, okay, what's been happening with us in China. Because the RBA said that inflation will peak around about 7% in late 2023, and start to ease in 2024. But things have changed between when they've said those comments. China's been slowing down for us. We've had our building construction approvals slowed down quite a bit. Housing prices have come back. We're seeing that these effects in the rate has taken part. So why haven't we changed? Well, to be fair with you, we need to see China either grow and stimulate their economy for us to go forward, or we need to see Australia really feel some pain. And this brings us to the Chinese economy, where they're our largest client. We give them 30% of our total exports in 2022. And consequently, the deceleration of China has put a big nail in the coffin towards a lot of things that we deem to be great exports of ours. And so we should be looking elsewhere, and we'll talk about that later on. We should be looking elsewhere towards our relationship with other nations. But China's slowed down a lot. The reason why they have been slowing down is because realistically the political power has taken control a bit more. The past commitments are not the same. The Prime Minister, the role that he has in China is not the same. Local government stimulus is not the same. The dominant China power that we've become fond of to fund our equity markets here in Australia and to fund our economy is not the same. The 90s have gone. We're we're about almost coming to, it was a bit scary to say, 40 years down the track. That's 30 years ago, the 90s. Scary to say, but it's true. And so if we talk about trade linkages that we've had with China, it's really been a major driver of our mining sector, major driver of a lot of our tech, funny enough, and our critical minerals and lithium stocks. Biggest buyers of electric vehicles are the Chinese market, the biggest buyers. And that sort of thing is having a bit of play. They've very much slowed down. A lot of household savings has increased in China. And to be fair with you, looking at their property market, it's at a very, very tight spot. Developers have been defaulting, and it's the sort of thing where if they continue to, the Chinese government must step in. But as I spoke about, the political power has been different. And so if I dive into a little bit deeper into political power, we have Xi Jinping, unfortunately, we have Xi Jinping reluctant to adhere to a lot of what have been affected in China's economy over the past 10 years. We have the Prime Minister, which historically used to have a major pivotal role in economic decisions. Currently, it's Minister Li Qiang. He's had a bit of a lack of influence in what's been going on. And the predecessor operates primarily under Xi's power, Xi's shadow. The local government in 2008, local governments were very much confident to stimulate their economies and build up their areas. But with the power from Xi, the local governments haven't passed much at all. It's been very much a power struggle. And so with this power struggle going on, the sovereignty risk with regards to Taiwan, our exports slowing down because the Chinese are not buying, well, realistically, we're in a bit of a pickle here in Australia. Now, if we move on to the US market, it's been a very interesting market as well. We could go into a bit of a deep dive with bond, but I could be here all day. We're just going to talk about, realistically, oil and how that's been affecting it. Because the US market has dropped 3.5%, 5%, and there's evidence that the labour market, as we said before, unemployment, has been very, very resilient. Even with the strikes that have been going on around the country, we have the riders, the manufacturers in the motor industry, and there's a few others going on at the moment. But they've been very, very reluctant still, with unemployment being very low. The Fed is trying to see a bit of that burn before they change. If they see that things are slowing down, the economy is under wraps, then they will change things. But they've been reluctant to. And the comments that they made only a couple of weeks ago means that they potentially won't cut as much next year. And that's something we have to be concerned about. How long do you think you could go on like this with interest rates how they are? Now, it's the sort of thing where if we put that with oil price in particular, cost of living is very high. We have oil producing countries cutting the supply. And so that means that realistically, demand's been slowing up a little bit, but them cutting supply has really driven up the prices of oil. And okay, harvesting of oil revenues ahead is going to be a permanent shift towards renewables. They're wanting to do that. We are seeing a bit of a change when it comes to when people want to be hitting their targets. We know in Europe that there's a few countries that are even backtracking from renewables going towards uranium, and we'll talk about that a bit more. But oil's been used as a political tool, and that's been driving up a lot of people's base cost. Anything to do with manufacturing, anything to do with exports, anything to do with industry, even household spending. Oil is going to be a major factor. And that has been, as you can see in the figure 1, increasing. I believe it's saying about 14, 13%. That's a big increase. That's a big, big spike. Now, the areas that have been performing, as we've been talking about, has been energy. We've seen that uranium, Paladin has been a great example of that. Bannerman Energy, Boss Energy, great examples. Silex, great examples of stocks that have been performing. But there's also been coal and oil. Coal with Whitehaven Coal, New Hope and Coronado, and oil with Karoon Energy. And it's the sort of thing where there are other stocks that have been undervalued, very much so. Pro Medicus, Liontown, Delterra Royalties, 7 Group holdings, and Costa Group holdings. There have been some great performance, but their fundamental value was very undervalued. Now where they sit, well, it's up to those analysts and your own analysts to do a bit of research. But I know for sure that when we sent out our recommendations for Coronado and for Karoon Energy back in June, back in July, that we saw that, it was a good time to be getting into those coal stocks and getting into those oil stocks because energy was going to come to fruition. And so this performance that we are seeing at the moment is due to a lack of supply. The coffers and the supply is very much decreasing. We're taking a lot of out as we've started to ramp up again. We slowed off and now we're ramping back up. Unfortunately, the biggest killer is because of the lack of supply, increase in price. We're seeing that with uranium. There's a lack of supply, increase in price. Uranium stocks are going crazy. The other reason why uranium stocks are going crazy is people are doing that backflip. There's a lot of European countries, France, the UK is even considered, Sweden's considered, doing backflips on the whole 2030 renewable landscape and go towards uranium as a source of energy. And realistically, it is a good source. Long-term benefits, marginal cost, it makes sense. And unfortunately, in Australia, we aren't as open, but I think policies might change. In the future, they may change. So this brings us to more or less probably why you clicked on the video and why you're watching today. Dividends. Are your dividends safe? Now, we do have our dividend portfolio. You can either scan the QR code or go onto our website. But the thing we have to factor in when thinking about dividends is consumption behavior and how it's going to be changing going forward. Because of the persistent inflation we have been feeling and has been sticking around, the rates are still increasing. Disposable incomes are decreasing. So we've got to think what sort of effects that is going to have on our stocks and on their dividends. We see already that the banks in particular have made great profits, but their yields have not increased. We see that mining has done really well over the last couple of years. Their retained earnings are awesome. Earnings per share are excellent. But they've also reduced how much they're going to be paying in dividends going forward. It's the sort of thing where just over 32 billion will be paid to investors between August and October, which sounds a lot, but that's down 24% on a year ago. And if you include dividends by major banks in early July, dividends fall 12% on a year ago to 43.6 billion. As I said to you before, the major miners cut dividends while financial payout to more shareholders. But analysts see that the dividend payout estimates are at a pace not seen since 2009. And in fact, the forward 12-month dividend per share estimates are going to be cut 14% year on year. So if we ask ourselves, why are they cutting it? Why are they slowing down with paying out? Well, it's simple. They're building a cushion. They're preparing for a slowdown. Now, whether that slowdown is going to be a major slowdown or a minor slowdown, well, we'll have to see. But there's absolutely some companies out there, which if you want to download our dividend portfolio, we're very keen to show you, that are producing some great cash flow, and that's the key thing go forward. Key cash flow, great returns and strong returns in cyclical environments. We're going to have a very sticky couple of years to come. The growth aspect of the market will come to, but realistically, and we'll get to it in our forecast, the next 12 months, there's going to be a few things that we would be avoiding. Now, if you want to find out what your portfolio looks like and what sort of advice that you should be receiving or what you should be changing, please go to our website, have a read of what we do, and book to speak to an advisor. We're quite happy to talk to anyone that needs help with regards to their portfolio. You'd see a bit of our past returns. You can see how we went in a troublesome year last year, and we did really well. And at the moment, if I go back, we've sent out some great stocks like Coronado and Karoon, where, it from where we got in, it's taken our profit. These are the sort of returns that we're very confident to see, even in a downturn of the market. So the forecast going forward, the world that we live in is going to go under significant change. And even beyond that, not even in the next 5 years, but the next 10 years, we're going to go in a different way. Technology is getting better. We've got the implementation of AI, which only now businesses are starting to understand how to truly use it. And in saying that, they still don't have a complete grasp of the capabilities. We have a lot of market volatility going to occur. We're going to have a lot of energy stocks go very, very well. And at the moment, we've got a lot of healthcare stocks that are undervalued. We've got a lot of technology stocks, as I said, because of what they do, are going to go very well. But whether the timing of it is going to be right, that's a key question. Now, as we already know, electric vehicles and with transition metals, is going to be key. So those line towns, those core lithiums, those Sayonas, those European lithiums, those sort of stocks are going to go quite well in the future. But is it the sort of thing that you want to be holding in a downturn? And if you're wondering those sort of questions, well, we can have a chat about it. Give us a call. Now, the thing that we need to be talking about quite a bit is our reliance on China. Now, as we discussed a little bit earlier, the China market is slowing down. There's two scenarios that I constantly talk to with my team. One, Australia finally wakes up and we aren't as reliant on China. We move towards other nations and try and develop our clientele base, you could say, with our exports, because we have some great exports. Our service industry is strong. We've got a strong grain industry. We've got a very strong tech industry that's coming through. Our cannabis industry is very strong in Australia, and realistically, I think should be appreciated a bit more. And our mining. We can't go past our bread and butter of mining. It's very strong. But if our client isn't as rich, isn't producing as well, and isn't buying from us as much, Well, we've got to look a different way. And that comes to India. India is going to be the next powerhouse for the next 5 to 10 years. It's going to be the place where low-cost labour and a lot of foreign investment is going to get into. And it already started. It's already started. This is already 10 years down the track. It's already begun. And that's going to be the dominant power with not only their population, but income coming from it. It's going to be the place to be. So going forward, we've got to be looking at how these companies are looking towards changing from China focused to more India focused, or even just in other countries like Africa, how they're going to be producing over there to take advantage of the low cost, to take advantage of the currency difference, to take advantage of the labor and the massive labor that they have over there. How are these companies going to take advantage? The other things that we've got to factor in going forward is how much debt do these companies have? I know for sure that interest payments are very, very expensive for a lot of people. Now, how much cash flow do they have to pay off their debts? Now, you can have a look at our dividend portfolio, and I do highly recommend that you have a bit of a look. We have a lot more information with regards to a bit more individual stocks and how we think going forward they're going to perceive and their dividend payment year moving forward. They're expecting dividend payment moving forward. But realistically, over the next 12 months, it's going to be a very volatile time. And there might be either little to no growth, but realistically, we've gone through a tough time. This has been a very tough time to be investing in the market. So what I want to leave you all with is the knowledge that even though it is a tough time in the market, realistically, things will get better. And if you are looking for help, please reach out. We're happy to give you some advice. And there's a few things that we have been changing a lot of our clientele's portfolios, which have done very well. And we're looking very positive looking into 2024. So to receive our in-depth daily market reports or join us as a member, scan the QR code, have a bit of a read of what we do. You can book in a call with an advisor. If you feel like you haven't had a chat to a professional in a while, give us a call. We're happy to talk about your stocks individually. And of course, we have the vision to outperform. But thank you for attending this. You can always have a bit of a pause of the video and read the information thoroughly. We do look to have a bit more of a in-depth analysis done from our analysis team in the next coming weeks. So do look out for that video. But thank you very much for your time, and we'll see you in the next video. Bye.